people ask me, it's like, I hear real estate is going through some turmoil right now, and where's the opportunity? And I tell people that you'll never find opportunity if you're not looking for it.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny Catani, and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Welcome to another episode of the Cash Flow Chronicles. I'm your host, Jonny Catani, and I'm joined today by Tommy Brant. Tommy is a recovering electrical engineer and data scientist turned full-time real estate investor based in Nashville, Tennessee. He started TB Capital Group as a tool to buy real estate with family, friends, and partners. He shows busy professionals how they can stop trading time for money so they can pursue passions and purpose by passively owning cash flowing assets. His portfolio consists of long-term rental, short-term rental apartments, invested in over 400 plus units, totaling 36 million in assets. Also invested in 200 plus unit build to rent and self-storage fund. Tommy, welcome to the show.
Jonathan, thank you so much for having me, man. I'm pumped to be here and hoping to add some value to your listeners.
Absolutely. We're grateful to have you. You're also a new member of Raise Masters, so stoked to have you there as well. I've talked ad nauseum here. I'm in my second year and pretty much built my business kind of on the foundation of what Raise Masters teaches. So I'm a huge advocate, and so welcome to that group as well. But let's get into it. You are a recovering electrical engineer. I love that. Give us your kind of genesis moment when you discovered real estate and kind of the story there and what's led you to where you're at now.
For sure. Yeah. A little bit of tongue in cheek. I'm still recovering, electrical engineer, also a data scientist there towards the end, but, in various capacities. I worked with 12 years with the same company. Like I said, various capacities in product support, sales, and then operations, business operations towards the end there, kind of more on the business analyst side. And, all of those things are very transferable to you starting your own business. So kind of interesting how that happened. I am based in Nashville, full-time in real estate investing, blessed to be able to say that. To be allowed to focus is just so critical to me in terms of starting my day and only having, one thing to focus on. But yeah, and I think it's a fair question of, how did I get to this point? Jonathan. So it's a electrical engineer turned real estate investor. If for those who are watching the videos, like a very sharp career path. But thankfully I kind of got shoved into real estate early on in my life, on accident, I would say. But it was a fun time. So, before I go too far, I will say that probably like most of your listeners, I've given into the narrative, and I believe that we're products of our environment. So I've given into the narrative that my parents taught me of go to school, get good grades, get a good job, and work until you're 65, and then fly into the sunset. Whatever happens whenever you turn 65. And so I was going to college, went to Georgia Tech to be an electrical engineer. I was looking for a summer job, after my sophomore year, and worked for a contractor who ended up being the primary contractor for one of the largest mobile home park operators in Middle Georgia. So they owned 1,000 units between Macon and Warner Robins, Gray. Are familiar with the Middle Georgia market, and we did everything you could think of, interior and exterior. And so we did everything from landscaping to pressure washing exterior, repairs, renovation on the inside, cleaning as well. And about 15% of the product that we serviced was post-eviction. And so you're coming into these places and there's clothes, there's trash, there's still, broken furniture, whatever they're kind of sabotaging in place on the way out. Utilities have been cut off for weeks. And you're playing the game of who's going to open up the fridge, not it. And, fun times. Right. And that did 2 things for me in life. One was that built a lot of character, and the second thing I'll say was that gave me the ability to have the vision of the finished product, right? To understand what is it going to look like after all the clutter is done, whenever you're walking into it. So if you can get past that kind of first emotional buildup and then, know what it's going to look like, then it's super powerful. And so, a a lot of work went into there. Fast forward a couple of years, I've graduated from college. It's 2011. I bought my first investment property. Really, it was just it was a house that was the cheapest in the neighborhood. It was a 4-bed, 2-bed, 4-bed, 2-bath. It had an attached garage, had an in-ground pool houses in the back, and Jonathan, doesn't it sound great? You know, it was a short sale, and let's peel back some of the layers. So there was a leak in the roof over the garage. So there was a nice sag in the drywall ceiling there. They had 15-foot joists instead of 12-foot joists. So we had to re-support the house structurally in different places. The pool was solid black. The pool houses had no foundation, so they could have blown over at any time. We literally just pushed them over, and that was it. And every square inch needed to be updated from 1979. And so that was, I'm a 20-something-year-old, and I wanted an outlet of energy. So I kind of asked for it, and I didn't really have a mentor at the time. So I'm wandering blindly, probably overpaying for certain projects, not prioritizing things accordingly. But, it was a slow live and flip, and I rented a bedroom out to a colleague at work. And so he was paying for the mortgage while I was saving up every year for all the projects that took place. While I'm doing that, I'm obviously still working full-time as an engineer. Coming home to this, on nights and weekends, it does something to your motivation every now and again. It's very cyclical as far as, let's get this project done. It's like you come home to it, you're like, I don't want to do anything. So you become a victim of your own success there. But around 2 or 3 years after owning the property, I get a letter from the city. And they said, this is what we think your house is worth. Congratulations, you're now paying this new tax bill based off of the appraisal. And it was over twice what I paid for it, and really I felt everything in terms of emotions, at that moment, because it's like, all right, on one end, I'm ecstatic, right? Because it's like, all right, I'm justified in buying in the neighborhood that I bought in. I'm justified in investing all this capital into the renovations and things like that. I'm just enjoying this equity bump. But on the other side of the spectrum, if I mind, the 25 years of go to school, get good grades, get a good job, the benefits from that in terms of salary, take home, 401k contribution, bonuses, and all this stuff, the equity in the house that I had just gained over 3 years had surpassed everything that, the previous 25 years, the results of that. And so I would say that, on the other end of the spectrum, I was devastated because my reality had been shattered, right? The foundation to what I believe to be the truth of me, being in that environment and me being the product of it. It really made me rethink some things. And I didn't realize it right away, but once I came across Rich Dad Poor Dad, my mindset around money really started to change. I started to rethink some things that, if you follow Adam Grant. So I was rethinking what I thought to be true. I started to ask questions, and I started to ask questions like, what's the difference between a person that makes $100,000 a year and the person that makes $1 million a year? And it's not time. Everyone's got that same 24 hours in a day. So I started to say, okay, well, maybe I could realign my goals or reset my goals. Maybe I don't need to wait until I'm 65, and just hope that my retirement is enough to live off on. What if I'm more deliberate about that? Maybe if I'm 55 or 45, what does that look like? And so I started to set these goals for myself. And then I started to have more of an investor mindset. So we liquidated that property. I'm going to fast forward here a little bit, but we liquidated that property, bought a couple single family homes, tried being a landlord, sucked at it, hired a property manager, started to find where my superpowers were, what team members I needed, bought a short-term rental, started investing passively in apartment syndication, getting passive income that way. And then, more speculative stuff like build to rent, and then more cash flow heavy stuff like the self-storage fund that took me to. And so, and then also we syndicated our first deal successfully last November, about 6 months ago.
Wow. That's quite the story. You've done it all, experienced it all, obviously felt all the ups and downs, of course, still more to come as this industry always seems to deliver lessons whenever we feel like you don't want them, but turns out you need them. So that's awesome. I love that. And, that is the power. And I love that you got started like that because, so many people get deterred, especially obviously here we are, right? We focus primarily on commercial real estate, and, so many people want to go straight to commercial real estate, and I can't blame them, right? But it's okay to start in that single family, the house hack, a duplex, whatever it is, right? It's okay to take 2-3 years and build up. And I love that it's led you, and now you've got an awesome portfolio. So let's kind of get into it. Let's start first with your first successful syndication. If you want to go ahead and tell us about that.
For sure. Yeah. And, I did skip over the part where I am aggressively consuming information through podcast, books, articles, and then the networking component of it is definitely not passive. So I'm going to meetups, conferences, webinars. So there's a lot that I had to figure out that wouldn't work for me before I find out what did work for me. And so, whenever I went full time with the intent of, building a business around multifamily syndication. So it was 14 months before we had syndicated our first opportunity. We were under contract on another one, but, just last year, throw out some numbers, we looked at over 200 deals, put out 70 offers, went under contract on 2 and closed on 1. And so that's year 1, and that's probably not atypical for a lot of your listeners, unless they have just a mentor that's trying to shovel them into deals or something like that. That's people doing them favors if they've got good connections. But that was just, being straight networking and trying to get involved. So it was tough. And that was 2022 for your listeners here. So, very competitive time to get into real estate. Yeah, as far as the deal that we did syndicate, the one deal that we did successfully syndicate last year, I think Ken McElroy did too. So I'm halfway there. As far as the deal that we did syndicate last year, that came to us, and there's so much power in the follow up nowadays because there's deals falling apart left and right at the closing table. People, sellers getting drawn into the buyers that are offering more than asking, that sort of thing. And then, oh, by the way, we don't have our capital stack lined up on the closing day, so we got to bail. And so this was same scenario where, we were not the best and highest offer. It went to the closing table, and I think we were second or third, and it didn't transact. It didn't go through successfully. And then the broker came back to us and said, hey, are y'all still interested? What are you looking like? And it seems like every week last year, the interest rate was going up. So we're like, okay, well, we need to pivot a little bit with our offer. Let's start to ask some more questions. Found out that they had an assumable loan. They had 7 years left on the term. They had just ran out of the IO period, so all that sweet music was over. But it's still an assumable loan, right? That would have saved in prepayment penalty, and they could, with that, they were able to sacrifice a little bit on price for us. So, we ended up making things work. So we bought 49 units in Louisville at 3.55. Wow. So that's around 72 a door. Mostly two bedrooms, but there were some 1-1 sprinkled in the mix as well. And so pro forma rents of around $925 without utilities. So,
Wow.
that was a pretty sweet deal, especially whenever you look at, comps, what is stuff trading at? It's probably high 70s, low 80s most of the time there. So just buying on a good basis, got a strong cash flow position. We came into that at 57% loan to value. And, on paper, if you're bringing more capital to the table, right, that lowers the returns, but it was still within the spectrum that we underwrite for, which is 100% return on investment within 5 to 7 years. So it still fit the, what we targeted. And I'm not offering to sell securities. We'll put a little disclaimer in there whenever I talk about target returns and stuff. But it was a strong cash flow position. We could have put supplemental debt on there and really juiced the returns, but I think just knowing that we are on the brink of, probably some economic uncertainty in the space, it's not a risk that we really wanted to take. We didn't need to take it. It just would have sweetened the pot. So it is a strong cash flow play. And, the break-even occupancy at the end of year 1 is going to be high 60s, low 70s. And so as we're seeing vacancy trend upwards, we feel really good about our strong, our low leverage position, relatively speaking.
That's awesome. Yeah, you made a lot of really great points there, right? Staying low leverage, extremely smart move. Obviously, as you mentioned, in this kind of ever-changing economic environment, interest rates, I believe, are going up again tomorrow. Is what seems to be where we're headed. So you made the right decision. And ultimately, investors, do you have a lot of new investors? Was it tricky kind of help get them to understand? It can be challenging, that I've noticed on the capital side, helping people understand why 6% is a good return right now. And and why we're not going to see 8% for a while, and why the LTVs are low. Is that something you had to kind of navigate?
For us, we did have a lot of first-time syndication investors on that one, and I think most people were, I guess, they're either drawn to, and this is different for every investor, right? But some are just like, any cash on cash, that's great, right? They may have more of like a development mindset of like, hey, I'm going to give you my money and I'm not going to see it for 3 to 5 years. So there's some people that were, like, oh, I'm going to get cash flow within 6 months. Like, all right, great. That's super exciting. And then other people that are just like, I just really want to know my internal rate of return, show me that and I'll be on my way. I don't expect anything for 5 years, but just show me that it's healthy returns. But I think a lot of people surprisingly were drawn to the debt on the property. So we had, it was like 4.7% interest rate, and they're comparing it to what's in the market. And they're like, holy cow, like you can still get this type of stuff even in today's climate. So there's a lot of people drawn to just the underlying debt for the property. And so
I love that. Yeah. If an investor is asking about debt, that's a pretty typically a sophisticated investor who understands, right, the debt market and why that interest rate is so strong. And so that's awesome. So have you guys made first distributions? Obviously with the low leverage, you're not at any risk with the changing interest rate environment. So have you made your first round of distributions? Or are they coming up? Is everything on track?
Yeah, we slated to do it within 6 months. And so May 1st will be our first distribution. We actually just got done issuing K1. So, and we're still on track for that. We're still right. If, budgets and actuals are pretty close in line, but last that I checked, we were under budget, which is thankful there because our renovation schedule is ahead of schedule. We did take some risks to evict more of the troublesome players, early on. That dips our vacancy a little bit, but that sets us up for success also for the warm season coming up for spring coming here. So, we decided to take that risk knowing that there'd be some seasonality that would create a little bit of a tailwind for us. So, and we probably could have started distributions day one, in all honesty, but that's a faucet that I don't want to have to consider turning off. After you turn that on, it's like, so we decided let's just take a little bit of a delay on the front end of this, knowing that whenever we do start it, we don't intend to ever stop. So it sets us up and lets us take a little bit more risk with regards to vacancy, getting the bad actors out on the front end.
So do you have some experienced partners, who kind of understood that? Because that's a pretty experienced play right there. You don't typically hear something like that in your first syndication.
Yeah, for sure. But between the property management that we brought to the market and the people that had been there, I think there's already a collective 100 plus units that they already have in Louisville, scattered across, some single family, or residential multifamily, as well as commercial multifamily, over 100 units across, I think it was like 6 or 8 properties. There's 2 people that live 10 to 15 minutes from the property. We're really pleased with the proximity we have. There's another deal where we're looking at, and part of the reason that it failed for the previous owner was they didn't have boots on the ground outside of the property manager. And so that's one of the first things that we consider now as we're looking at stuff in, middle Georgia, North Georgia, is like, who's going to be close to the property? And I don't count the property manager as being a sufficient answer to that one. So, but yeah, so definitely a strong team. I think for some of the people is either their second or third commercial multifamily in there. They're very knowledgeable about the market, had been doing it for over a year already, just in that one market. So
awesome. I love it. Yeah. It's always, that's the biggest thing I preach in the beginning is partnering with an experienced team, right? Willing, and I don't know what your percentage is, and obviously, we're not going to get into it, but be willing to take a smaller percentage if it means working with experienced people. Learn that, because if you do that correctly, you're going to be able to scale up to eventually, lead your own deals and kind of build that foundation. But you have kind of teased it. Obviously, a deal did not go to plan. And that's really probably where you learn the most from. So let's get into that one. talk about that deal, and then we'll kind of get into some of the valuable lessons that you learned.
For sure, for sure. The last thing I'll say as far as lessons learned for your listeners on the deal that we did close is expect delays if you're doing a loan assumption.
Yeah,
that will never be within the 60-day time period. So be sure to put, the ability to kind of purchase extensions, whether it's 15-day, 30-day, just make sure they get deposited into escrow account. They're not just, a fee that doesn't service you towards the principal there. So that's their last lesson learned. But as far as the deal that we did cancel contract on, that was one. This is in a Nashville submarket, probably 20 minutes from my house, honestly. But it was in. If you're looking at Nashville, I'm gonna just give you the path of progress here. But if you're looking at Nashville, you can probably tell by the interstate arteries where the path of progress is. So it's the south side. Southwest to southeast, they're just really building everything out. And so this was a submarket on the southeast part of Nashville, just along one of the interstate corridors. And, me being here, and I'm also connected with local business owners, and I know very well that the path of progress is feeding into the submarket. So whenever we found out that we got a pocket listing from a broker where they just want an easy transaction. They're representing the seller and they would be representing the buyer. They're going to do just fine. They don't need to push price. The seller seemed reasonable on their strike price. They said, if you can come anywhere near, this, $4.1 million purchase price for 50 plus units, let's talk. And so I guess, that was something that we were very interested in. With it being a pocket listing, we had developed a strong relationship with a broker, and I would say it's pretty easy. So they were hosting meetups a couple times a month. They were just trying to get engagement. They would have guests on some of their meetups, and I'd just toss some softball questions, get the discussion going whenever it started getting dry or getting quiet, and that's just always present in their mind. And so, whenever it came time for there to be a pocket listing, they sent it out to, 10 of their best buyers. We were on that list. And that was honestly, it was a big milestone for us. It's like, oh, these do exist. Like, and so, we analyzed it in quick order between, I don't share business equity with an individual, but I call them a strategic alliance partner. So we're underwriting stuff together constantly. So we underwrote it together, kind of poked and prodded each other's models, found a number that we were comfortable with. With the debt at the time, it seemed reasonable. We brought it to who we were pretty sure was the best buyer out of all the people that they sent the pocket listing to. And we formed a team around them. Right. And so we said, hey, look, this is our findings with the market research. This is our underwriting, this. And he was like, okay, well, I see you're conservative here, here, and here, and here. And then he's like, I like the deal, sleep on it. I'd like to be a part of the team. And so we came back to it the next day, it's like, all right, yes, we didn't even need to sleep on it. Yes, we want you on the team. He's like, great. What do you need from me? I was like, we need an asset manager. And so, and he's like, all right, I got a guy. And it was just really quickly, it was just a team assembled within a week that this was put together. And so, we received it on Sunday. With it by Thursday, we had the team assembled, had our purchase price. And then by the next Sunday, we were under contract. Wow. And so, one of the guys did visit the property, but, and everything was looking good, until, and I guess we were doing, we had our periods, right, where it was non-refundable. It was not hard money. So it was refundable earnest money. And so we're just, all right, well, let's get this on the table and get moving on it. And so we started the due diligence period. We were getting the plumber, the roofer out there for, inspection day. About the time that we are going out for inspection, we start to get their account receivables. And we started to find out that, hey, there's actually a lot of delinquencies going on here. And maybe this was my lesson learned in all this is that was the first question we should have asked for, even before going under contract is, let me see updated AR, please. And so, what we uncovered about the owner in this is that it was a single owner in California. They had syndicated the property. They did not have local boots on the ground. And based on the inspector that we had come out that day, he was also the inspector 2 years prior whenever it transacted. And he was like, It's the same. It's all the same. I could literally give you the same inspection report. Everything's just a darker red now because there's been zero improvements to the property. Wow. And so it really made me question, like, okay, did he have a business plan? And so there's all these red flags that keep going on in my head around just from an operator perspective of like, if he's my peer, like I would not have behaved like him, and so just interesting things to note along the way. And so I can tell you what they did wrong as an operator and how it kind of came to be. But the property management firm that they hired outside of Nashville, which was not a recommendation of the broker, by the way, they just went with lowest cost. Just red flags everywhere, Jonathan. They hired a tenant that was at the complex to manage the property.
Wow.
Another red flag, right? Because they eventually missed a payment. They said, oops, I forgot to it. And then the firm out of Nashville wasn't auditing bank recs. They weren't consolidating, AR and stuff like that. And so it's getting to the point where the property manager was not paying rent. They were coaching other tenants, the roommates, on how to not pay rent, and just word spreads across neighbors. And so before you know it, they had about half the complex owing money to the people, and the PM franchise had no idea until we pointed it out to them, or really until we started talking about it. Then I say we, so the owner, the broker, the buyers all discovered around the same time that there's basically fraud, accounting fraud, on account of the PM franchise. They had failed in their fiduciary responsibility there to handle money appropriately. And so that really killed the deal. Because he syndicated, he really couldn't wiggle a whole lot on his strike price. He's like, if I transact, it's going to be within this tight range here. We were able to negotiate, some stuff based off the physical inspection because it was just neglected for so long. But that was a tough one to swallow because there was just so much excitement behind it. But thank goodness we had veterans on the team, and they were kind of gut checking us. Is like, do you want to be in another deal 6 months from now that's super easy, like the ones that we're finding every day? Or do you want to be, stuck waist high in the mud, still trying to get through this? And, so we ended up canceling contract on that the day of, the last acceptable day of. And, a lot of lessons learned there, especially with regards to, non-refundable earnest money. I would say that there's so many things that I would want to know about the ownership team, and like, do they, what does their team look like? What was their strategy? Like, I'd love to see their investment summary. If they syndicated, like, are they ahead of schedule, or are they just running out of capital? Like, I really want to know more about the circumstance. Whereas I think most people will say, I really want this asset, I'm going to put non-refundable earnest money down there. It's like, you need to know so much more than just the asset. If you're going to do non-refundable earnest money, it's not, as prevalent in today's environment versus the super competitive environment that was 2020 through 2022. But yeah, that's a lot of lessons learned through that one that we had to cancel the contract on.
Wow. That's quite the deal. Nice to hear that it was, I guess in silver lining that it was on, the previous owner side, seller side, and not, a mistake that you guys made, or, not able to raise capital or something like that. Right. Mm-hmm. So able to get the earnest money back, kind of wipe your hands and move on to the next one. Definitely a bummer, but wow. A lot of great lessons to take there for sure. What's changed in your kind of underwriting due diligence, sort of even pre PSA? Has anything changed in that for you guys on the acquisition side?
I'd say so. Yeah. AR updated accounts receivables is what we want before we even issue an LOI. And so sometimes the timeliness is a challenge for that. If, there's a call for offers in a week and, I can't get it to you in that time, but you can kind of piece together what economic vacancy is by effective rents and things of that sort. So depending on what's presented versus are you dealing with someone that has receipts on a napkin, type setup there. So accounts receivables today, and for a lot of the markets we're looking at, we're seeing pretty much just older product come to market. And so we're asking more questions about infrastructure, like electric and plumbing related. So not to say I'll never do a product that's built in the 50s and 60s, ideally it would have already gone through a major gut rehab, where all the aluminum was replaced with copper, and all of the either galvanized steel or cast iron plumbing was replaced with PEX. So we want to factor that in on the front end. We don't want to get under contract, tear a wall down and be like, oh crap, it's galvanized steel, oh crap, it's cast iron. Because that is a 6-figure rectification, and that affects your returns, and that lets you know real quick how serious the seller is about selling, or how serious they want to stick to their price. As far as how else we've pivoted over the past 18 months, it's I'd say market has affected it also. If you talk about cap rate expansion, I think the tertiary markets, the rural markets, are probably going to go back into the 7 and 8+ cap rates, because they're not going to have that debt that can justify going down to 5 or 6. So we're looking more at primary, secondary markets. We're asking ourselves a lot of, do we think that there's still going to be hype in this market 5 years from now? It's hard to say yes to that, to tertiary markets. And if I'm being a fiduciary of other people's investments, then I don't like the situations where it's like, hey, there's this Ford plant going in the middle of nowhere, buy into the hype behind that. And it's like, show me that there's already organic population growth and draw to it. Don't try to sell me on a population 10,000 town and tell me it's going to be 15,000 in 2 years. So I'll let other people, be the pioneer. If things are looking good and healthy, then, maybe I'll buy a second or third in a market like that. But so we're sticking with primary, secondary markets currently, and within close proximity to that. We look at median income, not just for the city, but like by tract. I'm not sure if you're familiar with that, but like median income by tract is very telling. And so that you also make sure that the demographic can support the business plan that we have and within the 135 mile radius there.
Absolutely. I love it. Expand on that median income by tract for the listeners.
For sure. And I don't know exactly how that they're broken up, but within any sort of, city, there's breakdown of county, breakdown of districts. And then there's also a breakdown by tract. If you're looking in Dalton, Georgia, there's probably going to be 20 different tracts around the city, some within the city, the downtown city center, also expanding inward and outward. And so you can kind of see where, if there's median income growth on, in any direction of the tract, then you can kind of probably assume that, hey, that's the path of progress. If you want to draw some conclusions like that, there's probably also a correlation between median home price, but that's easily searchable through like Zillow or something like that. So, but the idea there is the median income tract gives us a much smaller mileage to look at whenever we're trying to understand the actual demographics within, a submarket or a neighborhood, something of that sort. So instead of me saying, oh yeah, median income for Dalton is $68,000, but I'm buying, a neighborhood to the east of the downtown area where median income for that tract is actually closer to 38,000. Can you really withstand, your business plan of trying to push rents to $1,500 a month, when really, if you have that 3 times income kind of rule there, then they need to be making $45,000 to $48,000 median income.
Yeah, I really love that you gave that example. That was a great example for the listeners to keep track at home, because it can be hard to understand why you would want such a nuanced piece of data, but you nailed it right on the head, right? Depending on where you're at, 1 block radius could be the difference between a 48 to 60 and 38,000. And that can be the difference, like you said, between whether or not, the demographic can sustain your business plan or not. So I love that. And that's an awesome detail, and kind of the details that you learn as you go. And so what, kind of pull out your muddy crystal ball here. What does it look like for the next kind of 12 to 18, 24 months for you guys?
For us, generally speaking, I think there's going to be a buy opportunity. What I don't know though, and I'm super excited about that, but I don't want to like downplay that. I'm pumped. I feel like I've been waiting for this moment for years. Like, yeah, finally. I just don't know what it's going to take, honestly. For the, we're in price discovery mode right now, where sellers aren't really wanting to sell at a price that aligns with the cost of new capital and the cost of new expenses. And, it's not just insurance and taxes we need to worry about, right? It's energy too, cost of repairs, labor, all that's kind of going northward. And so how long can it last of sellers kind of living in the past, so to speak? I'm all about people getting paid and getting top dollar for their product, but it's just, there's so much, there's not a lot of transaction right now, just because there's not the alignment. But what I do think is going to happen is that there will be buy opportunity. I have a hypothesis, so I'm really glad you asked me this question. So I think that for the people that are in trouble, right? Because I think most people that are in trouble right now is because of variable rate loans. And so are we going to see those come to market is my question, right? Or are they going to hide behind a curtain? And so I've heard some situations where there's a bank that knows an operator is kind of failing, right? Their reserves are dwindling over time, and there's basically an REO operation for 200 and 300 unit complexes where they're tapping the shoulder on one of their friends who's large multifamily operator, say, hey, the bank is saying, hey, this guy's in trouble, can you buy him out? For 70 cents on the dollar kind of thing. Here's everything about the property. They're struggling. They probably got about 6 months of reserves left. Is there anything we can do? And so there's situations like that where it's kind of a friend of a friend. You have to already be in the space to get exposure to that type of stuff. Then there's other situations where if a bridge lender or an alternative debt fund manager made the loan, then they're probably one phone call away from a syndicator or another multifamily operator. So they may just own the asset and have someone else manage it for, whatever asset management price there is. Foreclose on the existing owners. I don't think if it gets that bad, then that's not good for whoever the operators are, because that's the only way you can lose money. But hopefully the instances where that happens, people can navigate maybe refinancing, getting into a different debt product, cash in refinances, you've heard of that term, or just trying to extend their interest rate cap for their debt product. So I think that there's going to be a lot behind the curtain that we don't see. I think that there will be a misalignment for a long time between the sellers and the buyers. And so I don't think we're going to see discounts nominally, but we may see the opportunity represented more in terms of inventory. Like there's going to be inventory sitting on the market, and they just will not sell until it hits their strike price, or, to where their investors are made whole. So we were talking a little bit before this, but loan assumptions are kind of the only things that make sense justifying and yesteryear's price. But if we have to source new debt, then there has to be substantial discount, and sellers don't want to give that. So,
gosh, I love that explanation so much. You really, I completely agree. I will be very curious to see, you go to these conferences and everyone's like, oh, by Q3, like and it's like, but will we really, because you obviously see, how many operators there actually are out there. And there's a lot of really good operators. And, some of these operators have been in the same market for 10 plus years and have all the relationships. And it's like, the brokers aren't going to send this stuff out to market when a distressed seller is there. They're going to go right to a team, like you said, that they know could, first, that's going to be their first option. Hey, I know a team that is set up and can hopefully help us out here. And you won't even hear about it, right? It'll be a whole back channel deal, and that's it. So that will be something to definitely keep an eye on. Or there could be so much that stuff does go to the market, and, it's a bigger deal than we think in terms of quantity of bad debt. From what it sounds like, that's what everyone makes it sound like it's going to be like. Not necessarily some free for all where anybody can step in, but there's a lot of potentially bad debt out there that may be in trouble. So definitely something to keep an eye on.
For sure. Yeah, I think there's a saying that's getting made popular of survive to 25.
Yeah.
So if you have a variable rate loan product that can survive until then, you're probably okay. But if you have to transact or if your loan's coming due and this year, next year, then that's going to be a tough spot to be in. I don't envy anybody that's in that position.
Yeah, absolutely. I've been talking to a few other people who are kind of newer to the industry, and we were talking about how as challenging and as many kind of, headwinds as there are right now, it is kind of nice getting in now and getting exposed to it, because you're learning how to do it correctly, right? So that, like,
Yep.
the low leverage and the, having to raise more equity than normal, and fixed rate debt and all of these things, to where once things do ease up and the debt market becomes a little bit easier, the deals are going to almost just feel like, quote unquote, easier, right? As opposed to these operators who got in the last couple of years. Well, they're the ones who are going to be in the most trouble, because, it was just bridge debt left and right.
Yeah,
So as challenging as it is, it does feel nice from that standpoint.
for sure. There was a meetup that I co-hosted a gentleman with, and he was, mentoring student out of another ecosystem, and he was the only person I heard say, "I don't know about this bridge debt stuff," and he didn't do a deal for 2 years, right? And so it's one of those things where it's like, you can either try agency that's 100 basis points higher than that stuff and not do any deals, or you get into that product. So it's like, it doesn't surprise me, why the market's the how it got there, just given with how aggressive the lending terms were there. But I feel like he was the only smart guy in the room. He had the foresight to know, he'd been in it for so long, that to know that the further away you get from the fundamentals of buy a cash flowing asset with long-term fixed rate debt, the more risk you're taking on. And it seems like, today we had the hindsight to think that the bridge lenders were playing chess while the buyers were playing checkers. So interesting time. So, but people ask me, it's like, I hear real estate is going through some turmoil right now, and where's the opportunity? And I tell people that you'll never find opportunity if you're not looking for it.
That is a fact.
So we've, leveled up our underwriting. We've really gotten sharp on our expenses. And so I think we're well poised to take something down. The challenge right now is finding something that makes sense.
Totally. This is what I've been preaching, especially on this podcast, is for those who want to get involved, it's important to understand your market right now, to get involved in your market now, so that,
Yep.
I joke tongue in cheek, but, a good deal could kick you in the side of the head and you wouldn't even know it. If you don't even understand your market, so it's important to understand now, so that when the good deal does present itself, it's a good deal, and you can jump on it, because, whatever does happen, whether there's a lot or, it's all back channel stuff, it's going to go quick. I do believe that. I think there's a lot of capital that's been sitting and waiting, and I think that they'll move quick.
For sure. For sure.
Awesome. Well, Tommy, this has been absolutely amazing. Appreciate all your insight. I know the listeners do as well. We'll wind down and jump to the final five. First question: best advice you've gotten from a mentor?
Patience is a virtue. I think, and I'll add on to that and saying that no deal is better than a bad deal.
Yes. Right. Or they say sometimes the best deal is the one you walk away from.
Mm-hmm.
That's, I love that. What is about your career that makes you feel like you're fulfilling your why?
For me, I get to sleep easy at night. That's for sure. I'm not, I had a friend that he worked in an AI for a gambling company. And he's like, I'm not aligned with the mission of taking advantage of people and taking people's money. But for what we do, and, as a multifamily syndicator, we're improving the desirability of a neighborhood. Yes. But also through safety, or increasing the security of a place. We're making it more desirable, or building up a community together. And so for what I get to do whenever we actually do take an opportunity down and find an opportunity that aligns with us, I know we're doing the right thing and we're getting paid for it. There's so many times where it feels like I'm not doing the right thing, I'm getting paid for it. I won't say so many times. That's never really happened, but it's just like there's jobs out there where it doesn't align with your core. And thankfully, this is definitely something that aligns with my core. So yeah.
That's awesome. I love it. Favorite non-real estate or investment related book?
Non-investment related as well.
Yeah, right.
Okay. I do have an answer for this one. It's pretty fun, but there's a book out there called Story Worthy. And the premise, it builds upon the narrative that within every single day, there is a 5-second moment that you go through an evolution, or your affirmations are, reaffirmed. Sorry for that. Or you change your mind about something that you thought to be long-term truth, withstanding, right? You grow as a person, personally, professionally, right? There's a 5-second moment in every single day, spiritually, with your wife or with your spouse, what have you. But you'll never see it if you don't live presently. And so part of that is a combination between, having the capability to still tell a story properly, to do that 5-second moment justice and go through that evolution as a protagonist, in your story. And then, living life and being present and aware of it.
Absolutely. Very well said. Definitely one of the more challenging things to do, right? Obviously we've got so much going on, or can have so much going on, but very, very important. Love that. If you could have any superpower, what would it be?
I go back and forth with this every time I go on a long road trip. It's either the ability to teleport, or be like Magneto and control magnetic objects, because I just want to like move the cars out of the way, or like get to where I'm going. Which kind of goes against what I just said of, living life for the journey and not the destination. So maybe I conflict myself a little bit there.
Oh man, that's funny. Yeah, we say that until we have to go on a long road trip, and then we're like, you know what? I'm actually here for the destination. Let's just get there.
Traffic's a real killer.
Oh, that's funny. Yeah. Hard to live present when you're stuck in traffic. Oh, that's great. Cool. What's the best way for people to get a hold of you and learn more?
For sure. Yeah. And I'll preface this by saying that, I wouldn't get to where I am now without, other people taking, sacrificing time of their day to add value to me, whether that's through expertise or a mentor, or, books to recommend. And so I was thinking about what is something I could do to give back. And so I wrote the book called The Passive Investor's Guide to the Multifamily Universe. And so I made that a free download, didn't want to monetize any of that. So that was my way of giving back to the universe. But you can find that on my website of tbcapitalgroup.com, like Tango Bravo capitalgroup.com.
Awesome. We'll link that in the show notes, make it super easy. I love that. Will be a great resource. So I appreciate that value a lot. Tommy, thank you again. This was absolutely amazing.
For sure. Thank you for having me, Jonathan.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to KataniCapitalGroup.com to learn more.